Disney stock, ticker symbol DIS. This stock is down 28% year to date and will present quarterly results today. The stock is up 3% as of recording this video because of the earnings. So people do expect to see good results. To be honest, I have a bad feeling. Netflix plunged and the growth is slowing down at Disney as well. In this video I'm going to show you real quickly what Disney does, a view at the historical returns, the fundamental analysis, their major competitors, and in the last part I'm giving you my price target to see if Disney stock is a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about Disney stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does Disney do? Disney makes live action and animated films on the studios such as Pixar, Marvel and Lucasfilm, and also operates media networks including ESPN and several TV production studios. Next to that they have of course the theme parks and streaming service Disney+. We all know that Disney was hit hard during the pandemic and the theme parks were closed for a long time, which led to some bad results for Disney. They also cut the dividends, which is a good thing in my opinion. But the good part is that Disney found a new revenue source, which is Disney+. Revenue is divided into two main segments. Media and entertainment is the first segment representing 67% of the total revenue, and the second segment are the theme parks representing 33% of the total revenue. In this graph we see that growth starts to slow down a little bit, which is also quite logical. People were spending a lot of money on streaming services such as Disney+, Netflix, HBO, Amazon Prime and all of the others during the lockdown periods. But when things started to cool down, the growth of the subscribers started to slow down as well. We saw a decrease in subscribers at Netflix, so this is something to keep an eye on. Another very important number for Disney are the average monthly revenue per paying subscriber, or ARPU number. In the long run it's going down. But luckily since Q2 2021 it's increasing again. But definitely keep an eye on this number since this needs to be increasing quite nice and steady. So these are the numbers I'm focusing on, when they will present quarterly results later today. For now, let's check the historical returns to see what happened there. I decided to include the S&P 500 as a benchmark and Netflix as their main competitor for the streaming service. I also added Spotify, which is also focusing on a streaming service. Not TV of course, but on music. And since Disney is very diversified as a business, it's hard to come up with a main competitor. But I do think this is very interesting to compare. On the 5-year chart we see that Disney had a total return of only 9% versus the S&P 500 with 82% return. Quite a difference to say the least. Netflix still has a 33% return after the big decline in stock price. Spotify is at minus 17% return. Also quite interesting. On the 1-year chart we see that Disney had a minus 36% return while the S&P 500 is at only minus 5%. Netflix is at minus 54% and Spotify at minus 46%. So all stocks got hammered down quite a lot. On the 6-month chart we see that Disney still is at a minus 23% return. The S&P 500 is at minus 9% return and Netflix is at minus 43% return. Spotify has a minus 31% return. On the 1-month chart we finally see some positive returns again, with Disney at an 80% return. The S&P 500 is at 5%, Netflix at 27% and Spotify is at 14% return. So it seems when the market goes up, these stocks will go up more than the market average. But does this mean that Disney stock is a buy at current prices? Let's find out by checking the fundamentals of Disney stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. I also want to mention that I'm almost at 1000 subscribers, so please help me achieving this huge milestone by giving me a subscribe. In return, you will receive similar analysis to this one every week. Let's continue by diving into the fundamentals. Disney is a 196 billion market cap company with a PE ratio of 74, which is of course influenced by the lockdown periods. To me, this PE ratio is of course too high. But the 5-year average PE ratio looks way better at 34. Still too high, but it's looking better at least. 12 trailing month revenue is at 76 billion, and in this graph we see that back in the days revenue was quite steady. And then the lockdown periods begin. So I think it's a good thing that revenue started to climb up again. So this comforts me a lot. Net income is at 2.6 billion, which gives us a profit margin of only 3.5%, which is of course significantly lower than the 5-year average of 8.6%. So I expect that margins will become more healthier in the future, but still it's too low, even with the 5-year average of 8.6%. You want this number to be above 10%, so this is something I don't like. Another thing that I don't like about Disney is the low return on assets, return on equity and most importantly return on invested capital. You want these numbers also above 10%, and with the return on invested capital being significantly lower than the 5-year average, I'm a bit worried about these numbers. Next up is the balance sheet. Disney has 13 billion in cash, which they can use to pay down debt, buy back shares, do acquisition, investing in the theme parks, research and also to start paying dividends again, for instance. In the lockdown periods, Disney suspended the dividend and issued a lot of debt, since the theme parks were closed and they had a lot of costs without a lot of revenue or net income. Right now, debt is at 52 billion, which is of course too high compared to the cash position. But you have to keep in mind that this is related to the lockdown period, so you want debt to go down in the coming years and of course the free cash flow to be increasing, so they can start paying off debt and buy back shares, for instance. And to be honest, the free cash flow is quite interesting. It went up quite nice and steady before the lockdown periods, but the big decline we see is in 2019 and not in the specific lockdown periods. From there it never went up to old levels, which is of course related to the lockdown periods. But still, this number is quite disappointing to me. And it's pretty much the same story with the shares outstanding. It went down nice and steady, but in 2019 they started to increase a lot of new shares and never bought back from there. The positive thing here is that they didn't issue a lot of new shares after this big increase. The reason why they issued new shares is of course because they wanted to generate capital, because of the lockdown periods. So I don't blame them that much. Next up are the fundamentals of Disney versus some competitors. I decided to include Netflix and Spotify. We see that Disney is by far the biggest company in market cap and employees. Disney has a really high PE ratio, while Netflix is around 20. Spotify has a PE ratio right now, meaning they have no profit margin. Spotify and Netflix both have similar revenue 5-year compound annual growth rate, while Disney is at only 6%. Disney also has a negative net income compound annual growth rate, which is related to the lockdown periods. Netflix is at 64%, by far the winner here. It's the same story with the free cash flow. Netflix has the highest compound annual growth rate again. Netflix also has the highest margin, and Spotify has a negative margin. Return on equity, return on assets and return on capital is the highest at Netflix again, so they are the winner here. When we check the balance sheet, we see that Spotify had enough cash to pay down all their debt, which is quite interesting. Netflix and Disney both have a lot of debt compared to the free cash flow. So to me, Disney isn't the best stock compared to some others, but that doesn't mean that you need to buy Netflix and skip Disney. Let's check the price targets that I created using the Everything Money software. It's one of the best tools out there, so definitely check them out. I'm filling in a few key numbers based on the low, mid and high assumption to get my 3 price targets. Starting off with revenue growth. I expect that Disney will grow in the future in revenue. Parks are reopening and Disney Plus is getting more subscribers. Next to that, other revenue streams are increasing again, so this looks good to me. I'm filling in 6% on the low side, since this is the 10-year average, 8% on the mid side, which is around the 5-year average, and 10% on the high side, since I don't think they grow in higher amounts since it's a big company already. Profit margin is of course hammered down, and I expect things to become more healthier in the future. So I'm filling in 4% on the low assumption, 8% on the mid assumption, and 12% on the high assumption. Free cash flow margin is pretty much the same reason, 3, 6 and 9%. PE ratio is of course way too high right now at 74, so I'm aiming for 16, 17 and 18. Since Disney still has some potential to grow, but not in high amounts. So you don't want to overpay for this company. It's the same story with the price to free cash flow. My annual return will be 12.5% since I can get an easy 10% return with owning an ETF. I hit analyze and we see some green numbers, but it's a wide range. We get a low price target of 20 to 27. A mid price target of 48 to 64 and a high price target of 87 to $160. So if you believe this high price target, Disney might be a buy. but there's not much potential at $160 because the current stock is at $110. So to me, Disney stock is in the buy right now and they seem overvalued. My final conclusion on this stock is that I really like the company, but the stock is something different. And of course, you have to take into account the lockdown periods that had a big impact on Disney, but still, you don't want to overpay for this company. Whenever it drops to a range of $50 to $70, I think I would evaluate this company again. So for now, I'm skipping Disney stock. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.